Welcome to Talk Tickers, where we break down the latest earnings calls so you don't have to. Today, we are diving deep into BW LPG's third quarter 2025 results. Let's get right into it.
So, right out of the gate, the market did not like what it saw. The stock took a pretty significant hit in pre-market trading, dropping over 6% right after the report came out.
And here's the puzzle, right? How does a company beat on revenue by a whopping 15% and still see its stock get hammered? That's the big question we're here to unpack. Okay, let's dive into this because the headline financials, well, they tell a really conflicting story. This is a classic tale of two numbers. On one hand, you've got revenue coming in at nearly $280 million. I mean, that absolutely crushed the consensus estimate by over $37 million. A fantastic top-line result. But, and this is a big but, on the other hand, earnings per share came up short, a 19-cent miss. Now, that might not sound like a lot, but it works out to a 33% miss, and that is what really got investors' attention and raised some serious red flags. And this table really lays it all out in black and white. You see that big green beat on revenue? Fantastic. But then, bam, you get hit with the miss on GAAP EPS. And maybe even more importantly for a name like this, the dividend also came in lighter than expected. A 31% miss there is a huge deal for income-focused investors. So what in the world is going on here? Well, to really get it, you have to understand that BW LPG is basically two different businesses operating under one umbrella. And boy, did they have different stories to tell this quarter. And this slide just spells it out perfectly. Look on the left, the core shipping business was an absolute cash machine. I mean, look at those TCE rates, over 51 grand a day. That generated so much cash, it funded the entire dividend all by itself. Now look to the right, the product services division, that's their trading arm, it took a big, scary-looking $29 million accounting loss. But, and you have to read the fine print here, the actual realized cash profit was still a positive $15 million. You see the disconnect? And you can bet management was all over this on the earnings call. The CEO basically said, hey, look, that accounting loss is just paper noise. It's the realized results, the actual cash, that funds our dividend. He was really trying to get investors to focus on the cash, not the complex accounting. All right, so that's the story of the quarter. Now let's turn the page and look ahead. What did they say about guidance and the underlying fundamentals of the business? Well, the near-term picture looks pretty solid. They've already booked 91% of their days for Q4 at a really healthy rate of about $47,000 a day. But there's a catch. They've got a ton of ships scheduled for dry docking. That means they're out of service for maintenance. We're talking 121 off-hire days in Q4 alone, which means those ships aren't earning a dime. That's definitely going to be a headwind. This chart, though, really drives home just how profitable they are. Even with those Q4 rates locked in at $47,000, look at their all-in cash break-even point. It's way down at around $24,600. That means they are locking in a massive profit margin on those book days. It's a huge, huge buffer. Now, putting aside all that quarterly noise, management is still super positive on the long-term story. They're seeing more LPG exports and big-time traffic jams at the Panama Canal. This forces ships to take the long way around, which boosts something called ton-mile demand. Just think of it like this. It's the total amount of work the world's shipping fleet has to do. The more miles they travel to move the same stuff, the tighter the market gets and the more they can charge. It's a really powerful driver for their business. Okay, so we've got all these pieces on the board. Strong fundamentals, messy accounting, a big stock drop. How do we put this all together and come up with a rating for the next call? It really comes down to this core conflict. You've got management's view on one side saying, focus on our amazing shipping cash flow, look at the long-term story, and please ignore that temporary trading noise. And then you have the market's view on the other side, which is basically screaming, you missed on earnings, you disappointed on the dividend, and your guidance looks a little soft. Two totally different interpretations of the exact same report. So where do we land? We're calling it a market perform. You know, you can't really blame the market for reacting the way it did. The headline miss and those maintenance headwinds are real issues. But that underlying shipping business is still an absolute workhorse. So for now, we see things as fairly balanced. But, you know, we always have to give you our outrageous but plausible trade idea. The thesis here is pretty simple. We think this sell-off is a classic overreaction. The market's getting bogged down in accounting weirdness and ignoring that powerhouse shipping core. So the action? One could think about accumulating shares on this weakness, maybe anywhere below $12, targeting a rebound back toward $14.50 as the market starts to separate paper losses from real cash. Of course, it's not a sure thing. If shipping rates fall off a cliff, there's definitely more risk.
And that really leaves us with the big question heading into the next report. It all comes down to communication. Can management find a way to simplify this story? Can they convince the market that the trading arm's volatility is just noise and that the real story is the steady cash flow from their ships? That's what we'll be watching.
And as always, remember, this is not financial advice.